Through 2014 to 2018, Casper was everywhere on the internet, flooding advertisements to every trending podcast, website, and YouTube video. Need a mattress? Buy Casper. Not comfortable buying a mattress online that you've never seen or touched before? No problem. Buy your Casper mattress today, sleep on it, and if you're not happy at any time, return it for a full refund within your first 100 days, no questions asked. With a radically generous return policy and aggressive multi-million-dollar advertising budgets, Casper quickly rose to fame as the flashiest and fastest-growing online consumer brand hot out of Silicon Valley. Venture capitalists fueled Casper's rise, as they were all really eager to showcase Casper as another shining example of technological innovation and business transformation. Casper, Warby Parker, Dollar Shave Club were all pioneers of a new type of business model that venture capitalists were really obsessed with, called direct-to-consumer.
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 Go direct-to-consumer.
Direct-to-consumer.
To go direct-to-consumer.
The direct-to-consumer movement.
That direct-to-consumer.
Le D2C, direct-to-consumer.
They're able to get those prices because it's direct-to-consumer.
That's right.
The D2C business model is simple. One, you make a quality consumer product. It can be something as simple as a pair of glasses, a razor, or in Casper's case, a mattress. 2, you cut out the middleman retailer. 3, you brand your product with sans serif font, pastel colors, and other hipster designs. 4, you package that all onto a cool online website, and you sell your product direct to consumers at a low price. On paper, the advantages of this D2C model look pretty strong. Traditional consumer brands operate in a wholesale model. And so the only way that traditional consumer brands make money is by getting their products into retailers and selling in bulk quantities. Since all these consumer brands are fighting with each other to get their products into the shelves of Target, Costco, Kroger's, Whole Foods, Sam's Clubs, Safeway, and there are only so many shelves to go around, these consumer brands end up designing their products to appeal, impress, and satisfy the retailers rather than actually solving the end consumer's need. And so by removing the retailer from the equation, D2C businesses in theory can design and offer products to consumers that are higher quality and cheaper than the kind of stuff that they'd have to buy off the shelves of a Target. A D2C company can then promote its products very cheaply and efficiently through social media and sell them exclusively to customers over the internet, removing the need for real estate and storefronts. Eager to ride on Silicon Valley's hottest trends, venture capitalists all over the world poured their money into D2C companies, all eagerly chasing this vision as this would redefine e-commerce as we know it. Venture capitalists have poured over $3 billion to date into D2C companies. Casper was the shining crown jewel and poster child for this business model, attracting $340 million in investment over 5 years. The hype for Casper and the D2C business model got so big that even celebrities like Ashton Kutcher, Leonardo DiCaprio, Maroon 5, and 50 Cent all joined in as investors. Even big retailers like Target couldn't ignore Casper's rise, and those executives became so smitten with the idea that acquiring Casper would inject freshness, quirkiness, and millennial appeal into its antiquated retail stores, which is something that Target has long since been obsessed with.
If we go back in time, you would think about that Target guest, that Target shopper, as the suburban housewife. Now, she's pulling up in the van with a couple of kids, and they're certainly coming to our stores today, but we're appealing much more to that millennial family.
Target offered to acquire Casper for $900 million, but quickly found that Casper's founders were not willing to settle for a purchase of anything lower than $1 billion.
That shut everybody up.
Unable to match that price tag, Target settled for just being a pre-IPO investor. And in just a few short years, Casper had become a true Silicon Valley unicorn with a pre-IPO valuation in 2019 of $1.1 billion. Fast forward 1 year to 2020, where Casper was now making its long-awaited IPO debut on the public stock market. But instead of the glamour and champagne, Casper's entry into the public markets was widely criticized as a desperate, downright embarrassing disaster. The company ended up slashing its lofty billion-dollar valuation by 50% to $500 million in a last-ditch attempt to make the company palatable to public investors. Since its IPO, Casper's struggles have continued, dropping another $100 million in its valuation. The stock price has dropped by 40% to date, They've shuttered down their European business, they've lost their COO and their CFO, and they've ended up laying off 21% of their workforce. Casper's investors, including all the celebrities that had joined in at that billion-dollar price tag before the IPO, have all ended up losing their money. It's been an epic collapse for Casper, the one-time unicorn, darling of Silicon Valley, and the DTC business poster child. A startup that no one could seemingly get enough of has now quickly become taboo in venture capital circles. So what happened to Casper? The answer lies in the numbers. As a private company, Casper had been able to spin the numbers to its unicorn status, but as soon as Casper went public, its true financial performance was laid out for everyone to see. Casper had lost money in every year of its existence. In 2017, negative 73 million, 2018, negative 92 million, 2019, negative 93 million, and in 2020, negative 90 million. Losing money is nothing new to Silicon Valley and tech startups these days. To be honest, Wall Street has clearly shown an appetite in the past few years, and especially under COVID, to look past companies that were putting in losses and put hope in future growth. Look at Tesla, AMD, Datadog, and Atlassian. But in Casper's case, the reality is that it's not a tech company. Casper sells mattresses at the end of the day, not software or hardware. The average Casper mattress sells for about $700. After paying off the supplier and the delivery costs to get it from their warehouse to your door, Casper makes about $377 from each mattress sold. When you do that math, it actually gives Casper a very sexy and appealing 50% gross margin. So what's the rub? The catch is that Casper dumps all the money that it makes into advertising. In 2017, Casper spent 91% of its gross profit on advertising. In 2018, 80% of its gross profit on advertising. 2019, 73%, and then 2020, 60% of their gross profit on ads. This means that every $1 Casper makes off of each mattress sale, 60 to 73 cents of that $1 is going back into Facebook, Spotify, or Instagram for ad. That means that every company expense like salaries, R&D, warehouse, rent, delivery, website, design, customer support, all of those expenses have to come out of the company's pocket. Advertising is ultimately meant to grow, not to sustain a business. The nuance here is that online advertising itself has also dramatically evolved since Casper's founding in 2014. In 2014 and 2015, when Casper was just getting off the ground, internet advertising and influencer marketing online was extremely affordable. Running Facebook ads was a very easy, inexpensive, and effective way to target consumers, much cheaper than any billboard or television advertising ever was. But as more companies have flocked to Facebook, Instagram, YouTube, and other popular platforms to target consumers online, advertising has gotten saturated, competitive, and expensive. It's no longer just Casper who's able to dominate the airwaves with $340 million of a war chest. It's Casper and thousands of other D2C startups and big consumer brands like Unilever and Procter & Gamble all throwing in millions of dollars every year, targeting the same consumers, trying to hit the same demographics, and ultimately driving up advertising costs for everyone else. In 2019 alone, it was reported that the cost per click for Facebook rose by nearly 93%. To break this down into simple math, that means for every $1 a company used to put in to promote a Facebook advertisement, they would now need to put in at least $2 just to get the same result as before. The saturation and explosion of online advertising costs have popped the bubble not just for Casper, but also for the hundreds and thousands of other D2C startups that had all been fundamentally dependent on these unsustainable business models that were reliant on cheap online advertising and an endless IV drip of venture capital. But with the death of Brandless and the struggles of Honest Company, Everlane, and Dollar Shave Club, a lot of venture capitalists have begun to see their losses in D2C startups. Casper currently spends $275 to $300 to acquire a new customer. With the increasing competition from other mattress startups that have followed and copied Casper's identical business model, who are now aggressively competing for their same customers using the same online channels, Casper really has no choice but to keep throwing money into their advertising pit to stay competitive with their new competitors and to maintain their baseline growth. So with this in mind, Casper's business model basically boils down to 1. Buy a mattress from China for $400, 2. Sell a mattress for $700, 3, make $300 from that transaction, and then lose 20% of all the mattresses you sell every year thanks to your excessively generous 100-day return policy. And then after that, you take your $300 in gross profit and you spend it on advertising. You spend another $300 on your administrative expenses, and you'll end up losing $200 for every mattress that you sell. Now, Casper's massive advertising budget and strategy would be forgivable if all that spend was leading to a comparably large multiplier in revenue growth. But between 2017 and 2018, Casper only grew its revenue by 43%. From 2018 to 2019, that growth had fell down to 23%. Between 2019 and 2020, growth under COVID was a measly 18%. And that means that without even a one-to-one correlation between advertising dollar and revenue growth dollar, it's hard to imagine what the light at the end of the tunnel is for Casper to reach profitability. On top of that, the mattress industry reports that the average American only changes their mattress every 9 to 10 years. So Casper's first customers came in 2015, and that was when the company had been pricing its product at the cheapest and had been advertising at the most aggressive levels. With a 10-year-long deal cycle and product life for a mattress, it means that as an investor, you would have to wait until 2025 just to understand Casper's true consumer retention rate and standing in the mattress industry. But more importantly, it sheds light into the possibility that growth for the mattress industry is maybe just that slow and constrained. No amount of advertising is going to change the underlying market reality and consumer behavior. The fastest growing sales channel for Casper today is currently, wait for it, retail. Retail sales for Casper have grown 74% year over year and now accounts for 20% of the company's overall revenue. In comparison, its traditional direct-to-consumer sales revenue has only grown by 20% in the same period of time. Casper's retail sales aren't just beating their online sales when it comes to growth. The average order for Casper is 15% higher in retail than it is online. In the company's early days, the Casper founders were very prideful about never needing to open stores to grow their business.
And when we looked at the way people were buying mattresses, and it was still a very antiquated experience where you go to the store on every corner, you walk in your street clothes, you're expected to lay on a mattress under fluorescent lights and then know how you'll sleep, just seemed very perverse to us.
50% off, always signs, there's commission salespeople. It's like worse than buying a used car.
You know, we're totally different from the ground up. The shopping experience is completely different. We only sell our product through our website, Casper.com. You can take your time, read about the product and how we developed it. The customer experience is completely different from anything else, and it's not confusing. We designed it to be simple, straightforward, authentic, and transparent with what we build and how we build it.
Well, it's just one.
The ironic wall that Casper has run into here is that online growth is limited. There are only so many people you can hit online before your endless spam of Facebook, Instagram, YouTube, and podcasts just become exhausting and ineffective. So brick and mortar, the very thing that Casper was invented to disrupt, has now become that very slim bastion of light that the company's executives are hoping will save their business. Casper isn't the only DTC brand doing this 180 of embracing the very thing it was trying to disrupt. Everlane and Away, two other formerly hot DTC companies, have now found themselves opening stores and begging to get on the shelves of big retailers to try and grow their businesses.
Everybody loves to say you don't spend money on online, but the way it works now with Facebook and Instagram and how much it costs to acquire a customer, and then you have to ship it all, you end up, what online-only company is really profitable? Basically none of them. That's this dirty secret. With retail, when we move to customer first, we get to figure out which channel is right and do the right thing for the customer and be profitable.
Most recently, Casper shut down its European business to, quote, focus on the American market, but the numbers are pretty painful in that by all measures, the American market is barely growing and only becoming more competitive. Casper's future as a company just looks very bleak and painful. If you couldn't crack Europe, it's hard to imagine being able to crack any other major geographic market. Turning down that $900 million offer from Target before the IPO just because it wasn't $1 billion looks very regrettable by the day. With investor sentiment at an all-time low, geographic expansion out of the equation, and the bursting of the DTC hype bubble, Casper, the once untouchable Silicon Valley unicorn, seems now destined to become forgotten in a sea of worthless penny stocks on the New York Stock Exchange.